Hi everybody. We're still on chapter 4. Now this is class 13 part A for Monday, Wednesday, Friday. So Monday, Wednesday, Friday folks, you're class 13 getting divided into 2 videos. This is the first one, 13A. If you're in the Tuesday, Thursday class, this is the second video for class 9. So this is 9B, alright? And so up to this point, we've been learning about preparing the financial statements, right? This is what we call the accounting cycle. We have transactions occur, right? We're doing our business, transactions are occurring, we're analyzing them, journalizing them, posting them to the ledger, which we represent through T accounts. Then we balance all those T accounts and we move the balances to an unadjusted trial balance. We sit down at the end of the month and we think about, okay, what needs to be adjusted? What extra expenses are not reflected in these balances? What extra revenues are not reflected in these balances? And what do we need to fix? So then we fix them, we do some more journalizing, analyzing, journalizing, and posting. Then we take our new balances and do an adjusted trial balance. We use the adjusted trial balance to prepare the financial statements in a very particular order because we need the information to do the next one. We do income statement, statement of retained earnings, balance sheet, right? We do the 3 financial statements in that particular order. And then we're going to do something called closing, but that's next video. So at this point, we're ready to drill down a little bit on the financial statements because you probably noticed our financial statements we've been preparing are pretty simplified, right? They're good to learn about, and certainly a very elementary level company could have a financial statement just like what we've been doing. And what we're about to talk about is not that different from what we've been doing. It's just going to add a little bit of information. We're going to add a little more information about depreciation to assets, and we're going to make sure we're putting our assets and liabilities in their proper sections, because remember I said it's important that they go in the right order. So we're going to learn maybe a couple more little categories and divide our balance sheet up a little bit. All right, so we're learning about a classified balance sheet right now. All right, classified balance. It's just like it sounds like. We're going to classify the accounts into some slightly different accounts. So we're going to divide it up a little bit more. A classified balance sheet is a balance sheet that places each asset and each liability into a specific category, such as current or long-term. So we're just going to subdivide the asset and liability categories. Liquidity is a measure of how quickly an item can be converted to cash, because cash is the most liquid asset. So when we're dividing up our balance sheet, we're saying one measure we're going to use to decide if it's a current asset or not a current asset is liquidity, right? So cash, clearly very liquid. Accounts receivable are relatively liquid because receivables are collected quickly. Office supplies are less liquid, and furniture and buildings are even less. So, because they take longer to convert to cash or be used up. So being used up is also an indicator of liquidity. All right, so let's talk about assets and what makes a current asset, what makes a not current asset, long-term or a long-term asset. A current asset is an asset that is expected to be converted to cash, sold, or used up within the next 12 months or within the business's normal operating cycle if the cycle is longer than a year. The operating cycle is the time span during which cash is paid for goods and services which are then sold to customers from whom the business collects cash. Long-term assets are assets that will not be converted to cash or used up within the business operating cycle, or 1 year, whichever is greater. A long-term investment is an investment in bonds, which are debt securities, or stocks, equity securities in which the company intends to hold the investment for longer than 1 year. So companies can buy stocks and bonds in other companies, and they hold those as investments sometimes. Plant, and those are assets, right? Long term, more than a year. Plant assets are long-lived, tangible assets such as land, buildings, and equipment used in operations of a business. An intangible, so that's intangible, intangible asset is an asset with no physical form that is valuable because of the special rights it carries. For example, a copyright. It has right in the name. So if you're a publisher and you own the rights to publish something, that's an asset for you because you're going to be able to sell those books, right? So you can have a right that is worth money, but it's not something you can touch or see or feel. You just have a right. And so that's an asset, and it's long term. So let's look here, right? This breaks out the two categories. So if you were to look at a classified balance sheet, you'll look at it, and you know how we've always been running assets at the top of the assets column on the left? Well, now you just have two subcategories, current assets and long-term assets. All right, current assets converted to cash or used up in a year. So obviously you plan to use up your cash. Your accounts receivable typically don't go longer than a month or two. Supplies, you probably wouldn't buy as many years worth of supplies. Inventory, if you're a store, right? You're not gonna have your inventory around for years and years. So, it's pretty easy to think of current assets. Long-term assets, right? So things that are like a building, furniture, computers, land, intangible assets like copyrights and patents. We won't talk too much about them, but they are long-term assets. They last longer than a year. All right, so that's what we got going on there. Now let's talk about liabilities. We're going to subdivide those also. So in the past, we've been on the right-hand side of the balance sheet writing liabilities, and then we just write, accounts payable, notes payable, salaries payable, right, whatever they are. Well, just like with assets, we're going to classify them into a couple different categories. All right, so a current asset is an asset that is expected to be, I was reading about assets. A current liability is a liability that must be paid with cash or with goods and services within 1 year. So there's that same 1 year equivalency. With assets, going to turn it to cash or use it up in a year. With liabilities, current liabilities, you pay off within a year. Or within the entity's operating cycle if the cycle is longer than a year. A long-term liability is a liability that does not need to be paid within 1 year or within the entity's operating cycle, whichever is longer. So typically, you'll have some accounts payable, maybe some wages payable, some taxes payable, some interest payable, things you'll be paying off within the year. Those are going to go in the category current liabilities. And then maybe the company will have some longer term ones, like they've issued bonds, they've given a mortgage, right? They bought a building, so they have a mortgage at a bank, or they just have a note payable. They bought a bunch of furniture and signed a note payable for that or something. It's like a 5-year note or something. So liabilities get divided up, whether they're current, and current, that word current means within a year, or the operating cycle, and long-term, over a year. I think pretty much in this class we're just always going to deal with the operating cycle being a year. There are a few industries where it is longer than a year. Some organizations that make very large items like jet planes, tall office buildings, like skyscrapers. Some industry, the winemaking industry, actually, it takes 2 years. You plant the grapes, grow the grapes, harvest the grapes, crush the grapes, make the wine, let the wine age, and it takes about 2 years for that whole cycle to complete. So wine is actually usually on a 2-year cycle. So there's some companies, but don't really worry about that. Just keep in your brain, if the asset's going to convert to cash or get used up within 1 year, it's current. If the liability must be paid off within 1 year is current, right? And anything other than that is long-term over a year. All right, so the next thing about the balance sheet, right? So we talked about assets, we talked about liabilities, now we're going to talk about stockholders' equity. But really, we don't have any more classifications that we're going to add, right? There's not short-term and long-term equity, right? There's just the categories we've already talked about. Stockholders' equity represents the stockholders' claims to the assets of the business. The stockholders' equity section reports on the balance sheet is in part transferred from the ending retained earnings balance on the statement of retained earnings. The equity balance also reflects the stockholders' contributions through common stock. Equity section represents the amount of assets left over after the corporation has paid its liabilities. So when you think about it, A equals L plus E, well, A minus L equals E, right? So equity section is just telling the owners, here's how much you own of the company. If we were to pay off all the creditors, if we were to liquidate the assets and pay off the creditors, here's what's left over. All right? So, but there's no new categories. So on a classified balance sheet, which is what we're going to do from now on, classified balance sheet includes categories for current and long-term assets, current and long-term liabilities, but the equity section hasn't really changed. It's still common stock and retained earnings. All right. So here's your balances, right? And the this is where you get your, this is an actual classified balance sheet, and you can see this one is in statement form. All right, that's kind of a new concept. We've been doing them on the assets on the left, liabilities top right, equity bottom right, which is fine, and you can keep doing it that way. But frequently, if you were to look at a financial statement for an actual company, you might see it in this that we call statement form, and it just brings it down long ways. So it's the same section. Assets, which are current or long-term. In this case, they're calling them plant assets, right? Liabilities, current or long-term, and then your stockholders' equity section, not separate classifications, just the same as it's always been. So the classified balance sheet includes categories for current assets, long-term assets, current liabilities, and long-term liabilities. All right? So this is what a classified balance sheet looks for. But we don't really write classified at the top, we just write balance sheet because it's still just a balance sheet. So it's the same deal, but you just have two subcategories. So you got to know which category those assets and liabilities go in. But that's really it. So if you're in Tuesday, Thursday classes, this was the last video for your class 9. So you don't have to worry about another video till class 10. Get on that homework, get on that in-class exercise. If you're in the Monday, Wednesday, Friday class, we have one more video for you. So there's going to be a video 13B you still need to watch for Monday, Wednesday, Friday. All right, see you later.